Good afternoon, everyone. This is Darius Dell here, Senior Analyst on the Hedgeye Macro team. I'm joined via Skype with Hedgeye Sector Head for Demography, Neil Howe, for this latest edition of About Everything, where Neil's going to talk about the gig economy and the implications for investors. But before I turn things over to Neil, I just want to remind you guys, if there are any questions, we will have a live Q&A, so just pop your questions into that chat stream, and we'll try to get to as many as we can. With that, take it away, Neil.
Hey, great to be here again, Darius.
Absolutely.
Well, today we're going to talk a little bit about the gig economy. You know, a lot of people talk about it. You know, it's like the weather. It's not just that no one ever does anything about it. No one even knows what it is. No one knows how to measure it. And that's the subject of my About Everything column, which you're obviously free to read. And I'm here to take questions about. The kind of the hook line for this story is a recent announcement by the Commerce Department that they are going to do a study of the digital matching firms. And they have a long definition of what they're going to consider it. In other words, they're going to talk about the size of you know, the Ubers and the Airbnbs and the TaskRabbits and so on. These are digital matching firms, and how big they are as a share of the economy. But it reminded everyone of this broader issue of the gig economy and how poorly it's been measured and how little resources have publicly been spent trying to measure it. The last study actually attempting to measure what we consider the contingent worker universe, right? These are people without regular jobs, was done in 2005, believe it or not. It was called the CWS, Contingent Worker Survey by the BLS. And they came out with an estimate that as of around 2005, we had about 1.8 to 4.1 people working in their definition of contingent workers. And they defined this very narrowly, people who were explicitly contingent, meaning they had jobs that were not expected to last very long, either written or directly implied by their contract. So this actually is not what we consider the full universe of the gig economy. Another way it's often been tracked is by looking at self-employed people. This now is about 10.3% of the workforce, and it's been gradually declining, particularly because of the long-term decline in traditional self-employment jobs like agriculture and so forth. But here's the interesting thing. The GAO in 2015 came up with a broader definition of the gig economy, which I think is more in line with what we think of, meaning non-regular employment. And the way they define that is two criteria. How many people in America are employed either not as a traditional employee of an employer, you know, who pays their FICA and their payroll taxes and so forth, and is a regular full-time employee. That, I think, is what we normally think of as kind of the irregular employment, you know, that we want to talk about when we talk about the gig economy. Their estimate was that it was 30% in 2005 and probably grew to 40% in 2010. Do you see the interesting thing here? You have small definitions, narrow definitions of the gig economy which are gradually shrinking, but a more expansive definition of the gig economy which is growing. And that's kind of the main thrust of our piece. So the gig economy is large, it is growing, and we kind of take a look at that. We kind of go through the definitions and kind of guide readers through this murky area. There is, very interestingly, I think, speaking of kind of digital matching firms, JP Morgan Chase Institute, which is down here in Washington, D.C., and they go through credit card data. Obviously, they're a great issuing bank for credit cards. They have a tremendous amount of data on how credit cards are processed, obviously, and they were able to measure pretty accurately the number of people who are using what they call digital contractors. Namely doing, you know, mobile apps and so on, and actually earning their money through those means. And they put it now at strictly, now this is strictly mobile apps, they put it now at 1% of the workforce, and anyone who has ever had any income over the last 3 years in a mobile app form is about 4% of the economy. That may sound still small, but it's grown from virtually nothing about 3 or 4 years ago. So this is one important growth area. I think other important growth areas are part-time, which has obviously grown since the Great Recession. And clearly, I think everyone kind of sees a long-term secular trend toward this broader form of irregular employment. Just a couple of drivers, then we'll open it up, Darius, to questions that you may have or if any of our viewers have. But just a couple of broad ones I'd like to point out. One is sort of the regrowth of artisanal. The whole idea is that before 2000, CPG companies and big box retail chains were basically marginalizing the small mom and pop operations, the individuals, until the advent of e-lancing and Amazon and e-tailing, right? So what's called the long tail. You can, if you market something on Etsy or Amazon, you can be the 10,000th product and you can strike it rich there. And this has enabled a lot of individuals to go into business either in services or products. I think we've seen, for example, in a similar thing in agriculture, where very small organic farms and so on, very specialized, very high-priced food products are coming back into fashion with the rise of local production. I think the other big driver is the rise of the service sector. We've seen, and we have some charts in here on that, but clearly we've seen over the past decade and a half a huge shift from goods production to services production, and almost all of these contingent or gig economy jobs are service oriented. It's the Uber drivers, the TaskRabbit, Gopher, and so forth. And then finally, I think there's an interesting aspect that's generational. And I would regard this an important subtext to all this, and that is the generation that is now dominating the workforce is Generation X, and they were the ones who made the phrase, be your own boss, and free agency kind of mainstream in our society. They don't like to be part of big systems. They like to be able to, always have ownership of their own time and so forth. And I think they've made this idea of contingent work very popular. I think that an interesting consideration is moving into the future. Millennials, although often stuck in what the millennials call, permalance jobs, right, where they're sitting there in these contingent work arrangements without really choosing it. It's again less by choice than as an unfortunate reality. A lot of millennials would like something that's much more permanent, community-oriented, much closer, longer-term relationships with their employer, but they can't get it. And that gets to sort of a closing point, and which I would offer, and that is, given where we are politically and culturally in this country, we may soon be reaching, peak gig. I think it that way, in the sense that all of the new political currents having to do with providing safety nets to workers, raising their minimum wage, making sure they get paid for overtime, all of this formalization of employment we see going on politically, whether you're talking about the Democrats or the newly formed Republican Party is more on board with that as well. I think that the next phase of that, or an accompanying campaign that's going to go along with that war, is making sure employers don't make end runs around these rules with gig workers, right? And this is the important significance of the battle of Uber to make sure their drivers are classified as independent contractors, or for instance McDonald's, to make sure that their franchisees are independent from them. I think that these battles that are shaping up all have to do with efforts by maybe public opinion or certainly policymakers to sort of corral in or regularize gig economy, or perhaps even extinguish the gig economy to some extent in order to make sure that these protections apply. I do think that we're going to see more of that, and I think that's a part of a generational trend. I think Generation X will resist this move, and a lot of millennials will say, yeah, why not? Give me a little bit more regularity, give me a little bit more stake in my job. So with that, Darius, I hand it back to you.
Yes, it's a tried and true millennial. I very much enjoy my steak, pun intended. So yeah, actually the first question I want to ask actually just touches on this topic, and you kind of sort of hit the nail on the head with the regulatory threat. But do you see an actual sort of generational demographic threat to the gig economy, just as millennials rise throughout the workforce? Tom's asking specifically on that. Is the gig economy a trend?
In what sense?
Is the gig economy effectively here to stay, or is it a temporary trend based on sort of obviously millennials progressing through the workforce?
Oh, this is a massive change in our economy. This is not going to go away soon. And when I said, have we seen peak gig, I did not mean it's going to reverse itself overnight. I mean, this mode of delivering services and interacting with customers is a fundamental transformation. It's going to be with us for decades. I guess I'm dealing more with the second derivative. Do you know what I mean? Kind of, is the increased enthusiasm going to start tailing off? So yeah. I'm looking. This is a typical Hedgeye.
Oh yeah.
This is a typical Hedgeye perspective, right?
Totally.
I'm always looking at rate of change.
It's all about the rate of change.
So it is going to be here, it's going to be here for a while, and it's still going to be growing for a while. My question, as always, we ask this every time, dear, is the rate of change slowing down? And what I'm saying is looking longer term at the generational tectonics and where the politics are now going, you can see if you're sensitive to the mood of the times, you can see forces that are going to start putting a drag on that growth.
Absolutely. Perfect. And that sort of dovetails right into the next question here from Jim. And he says, how far behind the curve is the government in regulating these gig economy jobs?
Well, again, it's going to be a two-part war. In other words, what they're doing now is trying to regularize employment which is already irregular, right? So a good example is, ACA, the new overtime rules, which are going to go into effect just as Obama's leaving office. And this big move around the country toward $15 minimum wage, which, in a few years we're going to be seeing in more and more cities and states. As this happens, it will be accompanied by growing pressure by employers to offload some of these costs. Do you see what I mean? This will be a further incentive to go gig. And it's at that point where you're going to have these initial flashpoints we already talked about, the legal problems of Airbnb and Uber are going to become a major policy front, because obviously it's going to be it's policymakers are looking at this and saying, wait, you can't do an end run to unravel everything we're trying to ravel, right? Indeed,
indeed. And just before we move to the next question, can you just clarify the ACA regulatory changes that are coming down the pike?
The which changes?
The overtime changes from the ACA, just for those who...
Yes, this is a change. It's basically going to double the threshold of salaries, which will be applicable to the strict criteria of being a non-supervisory worker. Currently, you are due overtime, and your hours must be tracked so that you can be paid overtime if you are either under about $25,000 a year or you are in a non-supervisory position. So above $25,000 a year, it all depends on your job classification. Under the new rules, it's going to double to about 50,000, right? So this is huge. Anyone under that threshold is automatically required to be non-supervisory, which means they are covered by all of these BLS, not BLS, but Labor Department regulations. And then above that, again, it will depend on your job definition. And this is causing some interesting changes in obviously the hospitality industry, the restaurant industry, and in not interesting industries that are not exempt. I think one of the two that most interest me are prestige service industries, like fashion, where people come in and work for very low wages because they want to get ahead. There are a number of these industries where a lot of young people are willing to kind of work informally at very poor pay. I think another area which is very interesting is universities and colleges. The nonprofit sector is going to be hit heavily. A lot of the things we think of maybe being covered by this, such as teachers and a lot of state and local workers, are exempt from all of these regulations. So they're not going to be covered. But I think particularly you look at hospitality and restaurants, this is a big deal. And according to some of the surveys I've seen from the Los Angeles area, we don't have a lot of data how people are responding to this. One of the problems is that if you raise the ceiling, then you're very encouraged to take people near the ceiling and give them a pay raise. But then, of course, that tends to kick up everyone else. You know, you got to put, it tends to. And what they're noticing, at least in this recent survey I saw in the Los Angeles area, is that they are raising pay for these lower people, but they aren't raising earlier pay. At least our initial evidence is leading to real compression in wages in hospitality and restaurants. It'd be interesting to see how this plays out.
Indeed, indeed. So in terms of taking a 30,000-foot view, and if you consider all the regulatory sort of headwinds to the gig economy and obviously just to the regulatory changes you just outlined, sort of how does this all match up with our view on employment? How will this all impact employment, and then how does it match up with Hedgeye's macro view?
That is a great question, and it's one that I've trying to pursue. I expect to have something out, on our site soon about that. Mm-hmm. I've been really interested. I think one of the kind of perplexities, or let's just borrow Greenspan's word, conundrum. Right. A conundrum, right? That we've seen recently is that we've seen employment rise. The rate of growth of employment is slowing, but it's rising. And it's beginning to, and the questions everyone asking is it still way away from NAIRU? Is it still way away from really full employment in the market sense? And if you look at the previous, what we had before 2008, you'd say, yeah, it's still a ways away from that. But a lot of people are saying, no, those people have left and never come back, right? So we really aren't. But the question is, if we really were close, we'd expect some wage inflation, right? We'd expect some hour expansion. We're not seeing that, right? And before the next downturn, you always expect that to happen, right? You always expect that sudden pop in wage growth, and right, you hit the ceiling. That's and typically, historically, when the Fed puts on the brakes and so forth. We're not seeing that. So I think that part of the explanation we're not seeing that may lie in this new gig economy, right? That the answers we're getting from workers, particularly in the household survey, in the CPS data, which actually measures unemployment and labor force participation, all that, people are just asked, are you employed? And if so, are you full-time or part-time? And they have an hour threshold. That just doesn't get anything about how they're working, right? Yeah. It doesn't get anything about, are you an Uber driver that's just kind of going out on the roads when you feel like it? What kind of employment are you talking about? Yeah. And I think this institutional shift and this social shift in how we're defining employment is completely under the radar screen of our official employment statistics. Yeah. And my question is that explaining some of these anomalous patterns we now see at this point in the business cycle?
Well, definitely. I mean, you could think to the Atlanta Fed, who has this wage tracker, and they're basically calling attention to the difficulty in tracking wages across the various segments and people in the labor force, and this is definitely.
The thing that people don't understand about the Atlanta wage tracker and the fact that it's obviously been going up pretty fast, it's going up much faster than the other measures, is the wage tracker is only measuring people with continuous employment, right? So it's not getting the new people coming on, the older people leaving, the people that are changing jobs. And obviously, those are the people that, averaging into the whole economy, are pulling the averages down, right? Yeah. Those are the people. So it's only tracking the winners, okay? Let me just sum it up that way. The Atlanta wage tracker tracks winners only. And I just think that is why most people that I know that really look at all of the measures of wage inflation, a lot of them actually don't even look at the Atlanta wage tracker for that reason. It really is, it's a loaded deck.
Yeah, it's very akin to the stock market index, no? There's a survivorship bias.
No survival bias, right, exactly.
Absolutely. All right, let's flip it over to some financial markets and the implications therein. First question here from Bill. Aren't a lot of these gig economy companies still private, and what are the implications of that for investors?
Yes, they are still private, although some of them are. They are still private, although you have some public companies which serve these private companies. One good example is Intuit, which is obviously a public company. They do a lot of, I think their biggest line of business right now is probably mortgages, mortgage origination. But they also have a number of services for gig economy companies. Obviously, they do QuickBooks, and all of the accounting things. They also have a new payment system, and I'm trying to remember I'm trying to remember the name of it. I believe it's called. Yeah, they have a payment system. But the interesting example of a payment system I thought was interesting was this. Again, this is privately held. It's a company called Payable in San Francisco, which is software as a service. And it's being used by a lot of these companies to make it easier for contractors to get paid. Another good example of a company that just went public is Square. I don't know if you've ever gotten a haircut or your nails filed or anything like that. You see the person, they swipe the credit card through their little gadget on their phone, and that's produced by Square. That went public last fall. That's majority owned, I think, by Jack Dorsey, who's also the Twitter guy, right? Mm-hmm. That hasn't been doing very well lately. Yeah. But these are devices. I do think that when you're looking at software as a service delivered by the cloud, which is being just universally used by these companies, obviously mobile apps and mobile phones is getting a big, along with augmented reality and Pokemon Go and a lot of other stuff. I mean, they're receiving a new surge, I think, from this sector, right? So I think it may be less likely, it's less interesting to look at, who is actually delivers their services that way. Obviously you're looking at companies like Uber and so on. So you can look at the big ones that Uber is not yet public, but you can look at some of these companies that probably will eventually go public. But I think more interestingly, take a look at the companies which provide business services to this sector, right? Either directly or indirectly, and they will definitely be benefited.
Absolutely. And then, so you just sort of mentioned this, but question here from Bill. Uber just raised $3.5 billion, I guess, in the private market. Should we expect to see these gig economy companies that go public eventually?
Well, that's a whole nother question. Why these companies aren't going public? Why the unicorns that are still around aren't going public? Let me put it this way: if the S&P keeps going up, the answer is yes, they will definitely go public. I mean, the S&P kind of sets the price, and I think one of the reasons why, last fall we saw part of the reason we got startups, going. Private companies going public went down is obviously the valuations went down, right, as the stock market went down. So I think the going public is really a reflection of the overall comparison to kind of equity prices in general. You're going to eventually get to see interest in that. There may be, again, this is like a whole nother discussion, but there may be some longer term structural reasons why people aren't going public, having to do with new regulatory concerns and so forth.
Indeed. All right, let's get back to the economy for the last couple questions here. First one by GS says, this may be difficult to pin down, but are gig economy jobs generally low paying?
It is hard to pin down. And the reason it's hard to pin down is a lot of gig economy jobs are not really hourly, right? I mean, you think about Uber, it's kind of per ride. And you could have surge pricing, there are ways of gaming it so you earn a little more. I think, obviously, the general answer to your question is yes.
Yes.
Yes, they're definitely low-paying jobs. But they're not strictly low-paying in the sense that you aren't, that you're incentivized to do well. You'll be earned more by doing a good job. They often have ways of tipping and commissions and so on to allow you to to get a return on your effort. I think the big thing that people love about them, though, and this is why they became so popular, this whole way of thinking about your work is so popular with, becomes so popular with Generation X, and that is they always give you a choice. You can wake up in the morning and say, you know, today, I just feel like surfing. And I'm sorry, you know, I just, that's the way I feel today. And, you know, I don't have to show up. No one's going to shout at me. No one's going to do it. I'm just not going to work today.
Well,
that optionality.
I'm a millennial, so I'm going to go play Pokemon Go, and I'm not going to be surfing. Yeah. Tell Keith, hey Keith, man, I don't really feel like working today, man.
Yeah, why don't you try that out, Darius? See how that works.
I don't know how it works. I doubt it'll work very well. All right, last question here from Bill, sort of switching gears to a different subject here. Is that he heard you on the macro show, or heard on the macro show, that you were recently at Camp Kotok. Is there anything you'd like to share or can share?
Well, we're strictly Chatham House rules, so I can't quote anyone. But I can just give a general sense. There continues to be a lot of interest in the camp and the Brexit phenomenon. What are its longer-term implications? A tremendous concern for the future of Europe, and a lot of concerns for its political and social implications for future Brexit-like events in the rest of the world. I think, honestly, that was the top thing. As for Trump versus Clinton, I think that everyone there was so traumatized they almost didn't dare raise the subject.
Gotcha.
So, but I think that obviously one of the things we've seen over the last week and a half is just one of the most serious tanking of one candidate's probabilities, you know, in all of the, you know, and all of the poll tracking websites and all of the experts are tracking the odds that we've ever seen in a presidential race. I can't recall 10 days in which the odds have changed so much. Really? The question you have to ask is this, again, the bizarre transitory up and down in a weird election where everyone seems to hate both candidates? Yeah. You know, in which case you could imagine there's just a highly unstable equilibrium because no one really wants to vote for anyone, right? Yeah. Well, or whether this really is the nail in the coffin on the Republicans' chances. Again, that's probably something I'm surely going to issue a piece about.
Yeah, certainly, and I mean, I'm sure you'd have thoughts on this as well. But anytime you have sort of, you know, if you think about equity markets, if you have thin volume and thin liquidity, obviously a smaller number of investors can really impact the price. And so if you think about both candidates really having sort of the highest disapproval ratings really that we've ever seen for two sort of front runners, you know, you can get the sense that, you know, the markets are fairly thin. There's just not a lot of interest on both sides to really allow those polls to be skewed so heavily in such a short period of time.
Yeah, it's interesting, and I think also when you have an election where a situation where there's not a lot of historical experience on how that turns out, even futures markets have a hard time dealing with that, right? Mm-hmm. We do have, you know, unlike Brexit, where the futures markets were kind of hermetically sealed, and a very, I think, perhaps even fixed market, there is a somewhat broader market for futures, you know, in the election, you know, and we have, admittedly, the amounts you can bid are capped by the CFTC. I heard something really interesting, and again, I'm going to do this on a future episode. But one thing I did hear, and this is again sort of Camp Kotok information, is that the futures markets that people look to most regularly, there are only two futures markets you can legally bet on from the United States. They're allowed by the CFTC, and that's the Iowa futures market, and which is run here in the United States, and Predict It, which is run out of New Zealand, right? And you're strictly limited in the bets you can put on it. You're also, however, and this is a lesser known rule, there's also a limit on the total amount of bets you can have on any one position. And I heard from a number of people that for the first time, the betting is completely filled up on these sites. So there's no way for a new marginal investor to get a position.
Yeah.
This leads to some weird market anomalies. And it may be one of the reasons why you've seen such a flat line over the last month, you know, Hillary 70, Trump 30, was that there was no way for new bettors to get in. Again, I'm going to talk more about this, but it's really interesting because when we looked ahead on politics, Darius, we don't have the same kind of markets.
Yeah.
You know, that people assume we do. You know, they say, oh, you know, futures markets are predicting this. These markets don't work quite the same way.
No, they do not. All right, we'll wrap it up there. Thanks, Neil. I appreciate you joining us this afternoon, and then thanks everyone for joining us live. We'll catch you back here for next time on About Everything.
Great.
Cheers.
Thanks, Darius. Bye.